Hi guys, today we'll discuss Costco's latest results and valuation. Before we start, please don't forget the financial disclosure. This is neither a buy or sell recommendation on a stock, and I'm not a financial advisor, so please remember to do your own research. I have no position in Costco at the moment. The current price of the stock sits at $575, and I think that while this is a wonderful stock, current valuation levels are just too elevated for me to consider, and I give this stock a neutral rating. Costco stock returns have beat the market last year, as the stock was up 62% versus just 12% for the S&P 500. This is due to Costco's size and purchasing power that enables it to be a cost leader, providing the stock with one of the highest barriers to entry in retail. The inflationary environment that we currently live in has also been good for Costco stock. However, can the stock continue to provide good upside? This is the question that we'll try to answer today. In its FY21 annual report, Costco writes that it operates through member warehouses and e-commerce websites, operating a non-frills self-service business model that enables it to operate profitably at significantly lower gross margins than other retailers. It stocks less than 4,000 SKUs in its warehouses at any one time versus millions of SKUs carried by Walmart or Amazon. Online, they offer more SKUs ranging from 9,000 to 11,000. What does Costco offer? For all those viewers who don't live in America like me, Costco's food offerings, including food and sundries and fresh foods, make up half of its sales breakdown. Costco is one of the biggest food sellers in the country, and it sells both packaged foods like cereals and chips, as well as fresh foods like chicken. Costco's main appeal is offering the freshest ingredients at the lowest prices, and it's able to do so because of its fast inventory churn. In fact, many small businesses and restaurants will buy their food from Costco due to the low pricing and freshness. In addition, Costco also sells merchandise in its non-foods category. They are constantly changing offerings to help to keep the shopping experience new and fresh for customers, as things will change through the seasons, and this is another appeal of Costco's warehouses. The fact that Costco is one of the biggest retailers in the country enables the company to procure goods cheaply. But that's not all. In addition to its huge purchasing power, Costco works on the smallest markup in retail. With gross margins just above 10%, it implies that Costco marks up their products by just 12 to 13%, while other high-volume, low-margin retailers like Walmart mark up their products by over 30%. Yet with gross margins at such low levels, the company still operates with positive EBITDA margins. This is because of their membership fees. To enter a Costco warehouse or to purchase most of the company's e-commerce offerings, a shopper needs to be a member. Membership fees are viewed as extremely reasonable by most of people, costing just $60 a year. You can also opt to become an executive member at just $120, but you will get 2% back and up to $1,000 a year. Essentially, if someone thinks that they will spend $3,000 a year, which is done by $60 divided by 2%, then it pays to sign up for the executive membership. Small businesses and restaurant owners will far exceed such modest purchase levels. In addition, with people often spending $300 to $400 per Costco trip, it makes sense that they will upgrade their plans. As you can see on the right side, membership fees make up 58% of operating income in 2021, which means the company only runs on a thin 1.5% margin outside of fees. Fortunately, due to the extreme value proposition that Costco offers, total paid members have been increasing, with renewal rates at extremely high levels of 91% in the US and Canada and 89% worldwide. I think that this will only accelerate given the highly inflationary environment that we're in as consumers seek out the lowest costs. Now that we understand the key business model, let's go through some of their latest results. In the second quarter of FY22, net sales, excluding membership fees, increased 16.1%, driven by strong comparable sales results as well as the new opening of warehouses. For the first half of FY22, net sales increased 16.4%. Comparable sales were up 14.7% for the first half of FY22, including the impact of gas prices and foreign exchange, and 10.5% excluding the impact of gasoline prices. High gas prices are a tailwind for Costco. From a US website, gas prices nationally are sitting at a 14-year high in the US, with an average price per gallon today of regular gas sitting at $4.2. This compares to just $2.8 a year ago. The sharp rise in gasoline prices should generate higher total sales as the company has a price advantage versus peers. Costco's gas is typically priced at a discount versus peers. Since gas accounts for almost about 10% of total sales, this should lead into an increase in total sales as well because of both of an increase in ASPs, average selling prices, and volumes, as customers seek out Costco's rock bottom pricing. In addition, management historically estimated that around 50% of gasoline customers also come into the warehouse on their trips. Therefore, this could drive comparable growth and accelerate membership growth as customers take advantage of Costco's value propositions. This would also lead to higher overall sales and gross profits, but may lead to a lower gross profit margin going forward. This is because of the company's LIFO accounting, which means last in, first out, and the fact that gasoline is one of the products with the lowest gross profit margins. Looking at the first half FY22 operating results on its income statement, we can see a few things. Firstly, in the first half, membership fee revenue increased 9.8% to $1.9 billion, indicating healthy growth. Renewal rates also posted stellar results, 92% in the US and Canada and 90% worldwide. Gross profit margins of 12.5% was recorded, slightly down versus 13% in the first half last year. But despite that, operating margins were 3.4%, up versus 3.1% last year due to a decrease in selling, general and administrative expenses as a percentage of revenues. PATMI margin, which is profit after tax and minority interest, came in at about 2.6%, up versus 2.4% last year. Diluted EPS of $5.9 per share, up from $4.76 per share last year. Taking a look at its balance sheet, they also have a solid balance sheet, with the company having $11.8 billion of cash and $477 million of short-term investments compared to $6.6 billion of debt and $2.6 billion of operating leases, indicating that the company is in a net cash position. The elevated cash balance can also be paid out in the form of special dividends, and the management has said that they are considering a special dividend as they are now sitting on quote-unquote double its pre-pandemic cash levels. Despite its highly attractive business model, we also need to be mindful of where the stock is trading at now. After all, we don't just have to buy good companies, we need to buy them at good prices as well. On a last 5-year basis, Costco's next 12-month PE ratio has consistently traded at a premium versus the S&P 500, at an average 5-year premium of around 68%. Now this gap has widened up even more. Costco's next 12-month PE ratio is trading at 40 times, which is almost at 5-year highs, and is almost describing the company as a growth stock. Its current multiple is a hefty 108% premium to the S&P 500. On its historical 5-year next 12-month PE chart, we can see that the average multiple was 32.6 times. One standard deviation above its historical mean would be 37.6 times, but the stock is now trading at almost 2 standard deviations away and above from historical mean. While this kind of multiples are warranted given the company's consistent, high-quality performance, I think that this is a very rich multiple to be paying for the business. To sensitize what the stock price could look at if there's a D-rating in multiples, I've done a small table there. Brokers have forecasted a next 12-month diluted EPS of $13.78. Applying a multiple of 37.6 times corresponding to 1 standard deviations above, I will obtain a share price of $518. And applying a multiple of 32.6 times, I would be getting a share price of $449, which is all significantly lower than current price levels. Examining how Costco trades relative to peers, we can see that by revenues, Costco is one of the biggest retailers out there, just behind Walmart and Amazon. Despite operating at the lowest EBITDA margins, it is still able to operate profitably and register positive PATMI margins. In terms of earnings growth, measured by the next 2-year PATMI growth, it is expected to grow at 20.8% CAGR, a number that's in line with Dollar Tree Incorporated and BJ Wholesale Club Holdings, but behind Amazon's earning growth rates. Despite that, by PE ratios, it trades at one of the most expensive in the industry. Clearly, investors are pricing in healthy customer traffic growth and strong membership renewal rates, but I will argue that this is probably pricing in for perfect execution. Its calendar year 2023 PE ratio is trading at 39 times, just slightly below Amazon's 42.7 times. Other peers trade in the range of 15 to 20 times. Costco is definitely not an Amazon, and I don't think it should be trading at such high multiples. It is also trading at a mere 1.8% discount from its 52-week high price. When merely looking at broker target prices, we can also see that the stock is already slightly overvalued. And while broker estimates are not always correct, they serve as a checkpoint. It looks like there are other peers out there with more favorable valuations. With that, I'm not in a hurry to buy Costco at the moment. Do you have Costco stock? What are your thoughts on Costco at the moment? Leave them down in the comments section below, and I'll see you next time.